In 2008, a man named Robert from Chicago watched nearly half of his retirement savings disappear in just a few months. For more than 20 years, he had done everything he believed was right, working overtime, investing every paycheck, trusting the market, and following the advice of every financial expert he could find. But when the financial crisis hit, none of that protected him. The market collapsed, panic spread across Wall Street, and Robert lost more wealth in months than he had built in years. Later, he said the hardest part was not losing the money, it was realizing the warning signs had been there all along, and he simply didn't understand them in time. So after hearing that, I need you to listen very carefully. For the next few minutes, ignore everything happening on the screen. Forget the visuals, forget the captions, forget the charts. I want your full attention on my voice, because what I'm about to explain may be one of the most important financial signals investors receive this year. Gold has just hit record highs, and that is not normal. Gold does not move like this for no reason. When gold suddenly begins breaking records, it usually means smart money is preparing for something, and history shows that ignoring those signals can be extremely costly. Right now, millions of investors are asking the same question: why is gold surging, and what happens next? Because gold is not just another asset. It is not like a tech stock, a meme stock, or a speculative trade. Gold has been trusted as a store of value for thousands of years. People run to gold when trust in paper money starts to weaken. They run to gold when inflation threatens savings. They run to gold when markets become unstable. And most importantly, they run to gold when fear about the future begins rising beneath the surface. That is why this move matters so much. Gold hitting record highs is not just a bullish story for metals, it may be a warning sign for the broader economy. The first major reason gold is rising is persistent inflation pressure. Even though any headlines claim inflation is under control, average Americans know that reality feels very different. Grocery bills remain elevated. Housing costs remain painful. Insurance premiums continue climbing. Energy prices remain unpredictable. Healthcare expenses are rising. For millions of households, the purchasing power of the US dollar has been quietly shrinking year after year. And when people lose confidence in the long-term strength of paper currency, they begin moving toward hard assets that historically preserve value better during inflationary periods. Gold is one of the first places that money goes. The second reason is government debt. The United States is carrying historic levels of debt, and the number keeps rising. Every year, the government borrows more while interest payments consume a larger share of the budget. This matters because excessive debt eventually forces difficult choices. Governments either cut spending, raise taxes, inflate away the debt, or borrow even more. None of those options are painless. Investors understand that, and when debt begins looking unsustainable, confidence in long-term currency stability weakens. Gold often rises during those periods because investors want protection against future monetary instability. The third reason is central bank buying. This may be one of the most important, but least discussed drivers of the gold rally. Around the world, central banks have been aggressively purchasing gold reserves. These are not emotional retail investors chasing headlines. These are institutions with deep economic data, long-term strategic planning, and access to information most people never see. When central banks buy gold at scale, they are doing so because they believe holding more hard assets is prudent in the current environment. In simple terms, some of the largest financial institutions in the world are preparing for uncertainty. Now, does this mean a crash is guaranteed? No. Gold rising does not automatically mean disaster is coming tomorrow. But what it does mean is that the people with the most money and the most information are becoming more defensive. They are positioning for a volatility. They are reducing blind optimism, and they are preparing for a future that may be more unstable than the market currently expects. This is where many retail investors make a dangerous mistake. They see stock indexes near highs and assume everything must be fine. But markets can remain strong on the surface while cracks form underneath. In fact, Some of the most dangerous periods in financial history came when confidence was highest, right before conditions changed. Gold often begins moving before the average investor realizes something is wrong. It acts like an early warning system, a signal that large investors are starting to hedge against future problems. So what could happen next? There are three realistic possibilities. The first is that gold continues climbing. If inflation stays sticky, economic growth slows, debt concerns rise further, or markets become more volatile, investors may continue moving money into gold. In that case, today's record highs may simply be the beginning of a much larger move. The second possibility is consolidation. Gold may pause here and trade sideways while markets digest the rally and wait for the next economic catalyst. The third possibility is a pullback. If inflation cools faster than expected, the economy strengthens, or interest rate expectations shift, gold could retreat in the short term before deciding its next major direction. But regardless of short-term fluctuations, the bigger message remains the same. Gold does not hit record highs in a vacuum. It hits record highs when something meaningful is changing in the financial environment. It hits record highs when fear rises, when uncertainty grows, and when confidence in traditional financial systems begins to weaken. This also matters for the stock market. Historically, gold and stocks can rise together for periods of time. But when gold starts outperforming sharply during times of uncertainty, it often signals growing investor caution. And right now, that caution may be justified. Many areas of the stock market remain historically expensive. Investor optimism around certain sectors remains extremely high. And when valuations are stretched while defensive assets are surging, risk can build quickly beneath the surface. That does not mean panic. It means awareness. It means preparation. It means understanding that the market environment may be shifting even if headlines still sound optimistic. Because the worst financial mistakes often happen when investors ignore warning signs simply because the immediate future still looks calm. If there is one lesson from history, it is this: by the time mainstream media confirms there is a problem, markets have usually already moved. The people who prepare early are rarely the ones panicking later. They watch the signals before the crowd notices them. They study what smart money is doing. They understand that preserving wealth is just as important as growing it. And right now, gold is sending one of the clearest signals it has sent in years. That does not mean sell everything. It does not mean panic. It means pay attention. It means understand that the financial environment may be entering a new phase, one where inflation, debt, and uncertainty matter more than they have in a long time. So if you want to stay ahead of the market, understand the signals before everyone else does, and keep getting updates on the economic trends smart investors are watching. Make sure to subscribe right now, because the next few months could shape the financial future of millions of Americans, and the people who understand what is happening early will have the greatest advantage. Gold has just hit record highs. That is the fact. But the real story is not the price of gold itself. The real story is what that move may be warning us about. Because gold is not just going up randomly, it is reacting to fear, uncertainty, and deeper economic stress building beneath the surface. The question now is whether the average investor will pay attention before it is too late. History suggests many won't, but the smartest investors always do. Disclaimer: this video is for educational and informational purposes only and should not be considered financial advice. Always do your own research and consult with a qualified financial professional before making any investment decisions.